Hi, my name is Pat Connolly, and I'm a financial advisor with Connolly Financial Services. My practice is built upon serving the needs of individuals, families, and businesses in Louisiana for over 30 years. Most Americans have made substantial contributions to their IRAs, 401ks, and other retirement plans. The tax benefits make them an attractive proposition. You did not pay tax on your contributions, and your gains were tax deferred for many who are retired or are planning to retire. Their IRA and 401k plans represent the majority of their retirement savings. Now it's time to spend some of your savings to supplement your retirement income, and it's time to pay the tax man. Making one of the many common mistakes concerning your withdrawals, you or your beneficiaries could owe Uncle Sam far more than you ever expected. This book, The Top 10 IRA Mistakes, will help you make informed decisions and avoid costly mistakes. As you can see, the author has featured me on the back cover, and it will be my gift to you when we get together for your free 1-hour consultation. I'm sure you're here to learn, so let's get right to it. Mistake number 1 is missing a required minimum distribution. Many of you may already be taking distributions. They were due to be taken no later than April 1st of the year after you turn age 70 and a half. All future distributions are required to be taken by December 31st of each subsequent year. If you missed that first deadline, or if you missed any of those following deadlines, you will pay a 50% excise tax. That's right, a 50% excise tax. I want to point out that this is the number one mistake made by IRA owners and their beneficiaries. Let's look at the numbers, and we'll assume that in that first distribution you missed, you were supposed to take out $10,000. The date came and went without you taking action. Here's the $10,000 figure, and below that you see a deduction of $3,000, which is roughly what you normally would pay in federal taxes for that number. But here's the real pain point. Uncle Sam and the IRS have in effect become your partner in your retirement plan, the senior partner. The IRS will take 50% or $5,000 out of your $10,000 distribution. So what started out as $10,000 ends up with you getting only $2,000 for your retirement plan, all because you missed the distribution deadline. How would you feel about that? Sadly, it happens to people all the time. You need an advisor who is on top of all these details and won't let you lose the money that you worked so hard to save. Mistake number 2 is not taking advantage of what is called the stretch option. Not many people are aware of this option, but it can reap huge dividends to you and to your family. Here's what it's all about. Let's use the Bunker family for our example. They have $200,000 in their IRA. There's Archie and Edith, and they have a daughter, Gloria, and they have 2 grandchildren. Archie and Edith are both 65. Gloria is 35, and their grandchildren are ages 6 and 2. Archie and Edith have thought about a very important question regarding their IRA. When they are gone, who would they like the remaining money in the IRA to go to? And they decided that they want some to go to Gloria and some to each of the 2 grandchildren. So let's say 50% to Gloria and 25% to each of the grandchildren. Well, here's what happens when you use the stretch option. Assuming Archie lives to a normal life expectancy and that account grows at 5%, and all he takes out is only the required minimum distributions that we just talked about, he would have withdrawn over $177,000. Now we're going to make the assumption, because Edith is a woman, that she's going to survive Archie by 4 years. If this account is structured properly, there's no interruption of income, and over that 4-year period, Edith will continue to take out just the required minimum distribution, or RMD as it's known, which would total $71,000. Now there's going to be roughly $250,000 left after Archie and Edith are gone. That may seem odd since they started out with $200,000 and they've already withdrawn more than that. So how could there be $250,000 left? It's very simple. Let's say their IRA is earning 5%, but their RMDs are less than 5%. So that means that their account has been growing all this time. It's getting large. Sure, that's why there was more money left over for Gloria and the grandchildren than they started out with. Gloria would receive her 50% taken over her life expectancy, her stretch distributions over $265,000, and the grandchildren, even though they received only 25%. they're going to receive over $300,000 in payments over their life expectancy. The reason is that their life expectancy is longer and the money gets the compounding effect and grows longer, but if you add it all together, that $200,000 IRA, if properly structured, can generate a lifetime of income for 3 generations amounting to over $1.2 million. Let me say this again. A $200,000 IRA set up properly can pay out over $1.2 million of income over 3 generations. Don't you think that this is important enough that whomever your advisor is, that they should have explained this to you? Let's move on to mistake number 3, and that is not properly designated beneficiaries. The beneficiary document is the most important document in the estate plan. Only a designated beneficiary, and that's the IRS term, only a designated beneficiary can stretch these distributions and do what we just saw the Bunkers do. And only the owner or inheriting spouse can designate beneficiaries for stretch purposes. So this is something that must be done in pre-planning. This decision must be made while the IRA 401k owner or spouse is still living. Now, how important is the beneficiary document? Well, the United States Supreme Court decided unanimously that the beneficiary declaration in your qualified retirement plan has precedence over all other legal documents, including a last will and testament, when deciding who is the beneficiary of your retirement plan. Yes, it's that important. If you get nothing else from the information that I'm presenting today, I recommend that you come in and have your beneficiary documents looked at. I would say that around 50% of the people who have me look at their documents discover that it doesn't state properly what they want done. So you should do this at least once a year, and you should do it when there's a triggering event, such as a divorce or when someone passes away. Not only are beneficiary documents important in properly naming your beneficiaries, but can also determine how the remaining balance will be paid to the beneficiaries. So for example, if you have a spendthrift issue, someone who is not good with money, with all or some of your beneficiaries, then you can decide how much will be paid out and over what period of time. Mistake number 4 is not establishing separate accounts for each of your beneficiaries. Let me tell you why. Beneficiaries have different ages, and because of that, they have different life expectancies. For example, a 12-year-old inheriting part of your retirement plan has a life expectancy of 72.8 years, while another beneficiary, age 45, has a life expectancy of 38.8 years. If separate accounts do not get established, both beneficiaries will be treated as if they had the life expectancy of the oldest beneficiary, which is 38.8 years. Let me give you some numbers to make this clear. Here's an example of a man who lost his wife years ago. He had 2 beneficiaries that he cared about. They were his only daughter, age 45, and his 12-year-old grandson. And what he decided in the event of his death, he wanted half of the money to go to his daughter and half to go to his grandson, $100,000 each. Here's what happens without separate accounts. They will both need to use the life expectancy of 38.8 years, the life expectancy of the 45-year-old daughter, because separate accounts were not established. At a 5% rate of return, these numbers are rounded off a little bit. For the 45-year-old over her life expectancy, that $100,000 will pay out $313,000. Well, guess what? The 12-year-old is going to be treated identically. Why? Because they're having to use the same life expectancy, and we're assuming the same rate of return. So if you add up the total of all these distributions, that $200,000 inheritance of the daughter and the grandson paid out $626,000. That's more than 3 times the initial amount, and that looks pretty good. But if you're an expert and you understand separate accounts, you're going to set up the beneficiaries with their own separate accounts. Why? Take a look at what happens with the same $200,000 disbursement, $100,000 to each when you establish separate accounts. So the daughter and the grandson are still going to inherit the same $100,000. Because separate accounts were established, they now can use their individual life expectancy for the payout. And the daughter still uses 38.8 years, but the grandson now gets to use 70.8 years. So for the daughter, nothing changes. It's going to pay out roughly $313,000. But look at this next number closely. The grandson has 1 $100,000 inheritance, but over 70.8 years instead of the 38.8 years he was given before. At 5%, it is going to pay total income of not $313,000, but 3 times that much, $945,000. The total of all distributions now jumps from $626,000 to over $1.2 million. And that's all because of one simple thing that maybe somebody forgot to do or hasn't been trained to do. And that's to make sure separate accounts got established for beneficiaries that have different ages. If you have beneficiaries with different ages and you want to know how to do this, please make a note so we'll be sure to talk about it. Just remember that one little mistake cost the grandson over $600,000 of income. That's a staggering financial loss for the younger one. Here's another important consideration. Do you have a trust? I believe in trust, but I want to point something out that is essential to know about trusts and retirement plans like IRAs. I'm going to read something right out of Publication 590 of the IRS Code, and I quote, "The separate account rules cannot be used by the beneficiaries of the trust, and that means using the trust for your IRA literally could cost those younger beneficiaries a fortune. If you're concerned that if you're using a trust to determine who's going to inherit your IRA, make a note, and we'll be sure to talk about it. A lot of you may have your retirement accounts in a safe investment, but do you know over 80% of retirement accounts are at risk in the stock market? So let's talk about mistake number 5, which is having too much of your retirement account at risk. The fact is, if you're going to need the income from your IRA, or if you want to leave a legacy for your family, or maybe a combination of both, it's up to you. Risk is the first thing that can ruin your retirement plans without warning, so we'll be sure to talk about this. Do you know that Albert Einstein once said that the most powerful force in the universe is compound interest? Those who understand it profit from it. Those who don't, pay it. Here's what I mean. Let's imagine it's the year 2000 and you have $200,000 to invest, and you decide you want to diversify. That means you're going to put some of it in the stock market. Let's just call that investment the S&P account. That $100,000 will perform each year identical to the S&P. To play it safe, you decide to put the other $100,000 in a fixed account that's only earning 3%. Let's see what would have happened. Well, we know the first 3 years of that decade were not good years. We saw the tech bubble crash, and of course 9/11 took a toll on the stock market. So look at the S&P account. The stock market dropped for 3 straight years, and your $100,000 that you started out with is now worth $59,000. Now over here at the fixed account at 3%, you're at $109,000. Now when the stock market drops like that, what has to happen for you to get your money back? Well, you're going to need 4 or 5 years of good market growth, and that's exactly what happened from 2003 to 2007. The stock market was a bull market. But guess where you are? Right back to where you started, just under $100,000. Over here, the fixed account, you're at $126,000. And then unfortunately came the year of 2008 with very little warning. The S&P 500 dropped over 38%. Some people lost over 40% in the stock market. This is now down to $61,000. And over here at the fixed account, we're at $130,000. Once again, what do you need to do to get your money back? Well, you need good market years. And we had 23% growth in 2009. And in 2010, we added another 12% growth. So after 10 years, you're still down $15,000 from where you started. And over here at the fixed account, you're at $138,000. By the end of 2016, you would have over $150,000 in the S&P account and over $165,000 in the fixed account earning 3%. My question is, which account would you be more satisfied with today? Mistake number 6, overpaying fees and loads on your IRAs, 401ks, and other retirement accounts. This mistake can cost more than income tax. Let me give you an example. Remember the Bunkers and how they wanted to stretch their IRA at 5%, and Archie got his money, and Edith got hers, and Gloria got over $250,000 and over $300,000 for the grandchildren. That's with no load at 5%, with a total income was $1.2 million. If you take that same money, that same 5% return, using that same stretch option, but there's just a 1% fee or load, here's what would have happened. Archie gets less, Edith gets less, Gloria and the grandchildren get significantly less. The total payout would drop from $1.2 million all the way down to $768,000. And that's just at 1%. If you were about to make a mistake based on a myth, a misconception, or misinformation, and it was going to cost you over $600,000, wouldn't you want someone to tell you about it? You may be comfortable with the fees and loads that you pay on a mutual fund account, or you may not. But the truth of the matter is that you owe it to yourself to find out what you're paying in loads and fees and how they affect your retirement accounts. Mistake number 7, not taking advantage of tax saving strategies. We all want to pay our fair share of taxes, but nobody wants to overpay taxes. So let's look at the Roth conversion. You may have heard of this. Understand that from the first day you contributed to those retirement plans, which could have been as early as 1974, Uncle Sam has been your partner. The unfortunate reality about this partnership is that Uncle Sam has control. He will tell you when you're going to pay the taxes and at what rate the tax will be. So the Roth conversion is simply a technique of firing that unwanted partner, which you can do for the fewest dollars possible and take complete control of your retirement account. So here's how it works. Everything's going fine. You haven't had to take any money out. You're having your 70th birthday. You haven't had to pay any taxes prior to distribution. But 6 months later, when you turn 70 and a half, guess what happens? And guess who shows up? Your old partner, Uncle Sam, comes back and says, "Hey, remember me? This is not your retirement account. This is our retirement account. And I am now going to tell you how much of it belongs to me." Now, if you're like most people, you think that IRA stands for individual retirement account. That would mean it's your account, right? Not so fast. The Roth conversion can get rid of that unwanted partner and may be the best solution, but there are some drawbacks. You have to pay the tax on your IRA when you convert. Guess what? You don't have to do it all at one time. You can do it over 5 or 10 years and just keep yourself in a tax bracket that you're comfortable with. Once you convert your IRA to a Roth IRA, you're no longer forced to take any distributions. Uncle Sam no longer has an interest in your account or accounts, and all future gains and all future distributions are now going to be taken out income tax free. Anyone who has an IRA can convert it to a Roth. So the point is, for some of you, a small tax bite today could save a fortune in taxes tomorrow. So let's move on to mistake number 8, and that is not moving your 401k, 403b, 457, and self-employed pension plans or any other company-affiliated plan to a more flexible IRA. The real question is, what should you do with these 401ks? What do you do with old 401k or 403b when you retire? You have 2 choices. You can leave the money in, or you can roll it into a more flexible IRA. So let's examine both options. If you choose to leave your money in the plan guideline can restrict your access to your money. They have a rule book, a plan document, and whatever that plan document says, that's the rule and limits what you can do. Your investment options are also limited. Let's say you're with ABC Company, and that is the company that is handling your 401k, and they are offering 11 different mutual funds. That's what you're limited to. Also, you have limited distribution flexibility for the children and the grandchildren because these plans don't offer the stretch option. You cannot stretch your 401k, and many of them do not offer the Roth conversion. Let's contrast that with rolling the plan into a more flexible IRA. A direct rollover is the only way to go because it avoids the 20% mandatory withholding. Direct rollover just means you never touch the money. The current custodian sends it directly to the new custodian of your choosing. If you roll the plan to an IRA, your money is still tax qualified, so it grows tax deferred. But now you control where the money is invested. The entire universe of investment options is open to you. IRAs offer both the Roth conversion and the stretch option. So 401k and 403b planning can eliminate a lot of costly mistakes for both you and for your beneficiaries. Mistake number 9 is having too many retirement accounts. That's right, too many retirement accounts. Your money is in too many places. Just look at this guy. Why does this happen? It's really simple. It's because of the way that Americans save money. Here's the question. Which account do you draw from first and why? Which account do you draw from last and why? Are you losing as much money in one account as you're gaining in the other account? In other words, are you just breaking even and don't even know it? If you can make 10 major mistakes that you can make with your IRAs and your 401ks, just imagine if you have 10 different accounts. You've just increased the possibility of mistakes by 10 times. You may want to consider consolidating all of these accounts into one easily manageable IRA. You may need a second account for your non-qualified savings because you cannot have qualified and non-qualified savings in one account. Let's move on to our final mistake, number 10, not getting a second opinion. Obviously, we've all heard about getting a second opinion when it comes to your health. Think about it. You're visiting your general practitioner for an annual exam, and he listens to your heart and he tells you, I want to make you an appointment for next Tuesday to come back again. I think you may need open heart surgery. Now, of course, you wouldn't want that because that family practitioner doesn't have the training. They don't have the qualifications or the experience to do open heart surgery. So naturally, you get a second opinion from someone like a cardiologist who has the training, they have the experience, and the expertise to give you good advice. With all the things that are broken in our healthcare system, there's one thing that works well, and that's the referral system. Unfortunately, in the wealth care system, there is no referral system to get you to the right advisor who has the experience, has the education, and has the training to guide you through the retirement distribution phase. You have spent most of your life accumulating money in what we call the accumulation phase. Hopefully, you did well. Hopefully, you got a great rate of return. And accumulation was the phase you were in with all the advisors. You know, the people that gave you advice about where you should invest your money during accumulation. But guess what happens? We all move on into the distribution phase where we're going to need that money and we're going to need to spend it. I would guess that 99% of advisors do not make the transition to the distribution phase with you. They may be skilled accumulation advisors, but they are not trained in the more complicated distribution phase. Just like the general practitioner who is not trained to do heart surgery. Now, why is this so important? Accumulation is easy. With your IRAs and 401ks, you only have 3 things to consider. Am I eligible? How much can I contribute? And where do I want to put the money? But when you start taking money out of these accounts, now it becomes an IRS payday. Now there are a lot of rules. The Internal Revenue Code is strewn with landmines. But there are also golden nuggets in there as well. The trick is to navigate the landmines and harvest the golden nuggets and get the most out of your retirement accounts. And to do that, you're going to have to seek out the help from somebody that has the training, has the expertise, and can guide you through that distribution phase. I have taken the time, I have the education, and the experience to help walk you through that maze during the distribution phase. So give some thought about getting a second opinion from a trained IRA distribution advisor. This can help you because a second opinion from a trained IRA advisor could save your family a fortune in taxes, fees, and loads. If you would like to schedule an appointment to get your complimentary copy of the top 10 IRA mistakes, simply fill out the form for your no-cost, no-obligation meeting with me, and we'll make sure that you're not making any of these mistakes in your retirement plan. I'm Pat Conley. Thanks for your time, and have a great day.